Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to take a deeper dive into the economic data in the markets to try to see if they make any sense. And definitely they don't make any sense today. We had a non-farm payroll report come in at 136,000 jobs. Out of that, 114,000 were private payrolls, and the market really got excited about it, which is quite odd because given the scope and size of our economy, it's actually not that great. I mean, when you think 136,000 jobs out of how many working age people there are, it's actually pretty low. And historically, if you go back to post-World War II cycles, when you start getting non-farm payroll reports under 150,000, which we are, on the slide down, which we are, it tells you we're on the edge of recession. And you say, well, why did the markets get so excited about that? Well, non-farm payroll reports, much like all of the other data the Federal Reserve uses to determine monetary policy, is lagged. We know the payroll reports are lagged by approximately 4 months, and this is not good. In fact, we already know over the last week or two, we've heard more and more companies come out and are laying off or shuttering their factories for a little bit or reducing production. And then this week we had both the ISM factory PMI and services PMI. The factory data said that employment is contracting, and services said employment is really, really super slow. So the notion is the economy isn't all that great, but stock investors today thought it was the best news they could ask for. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by or selling a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity, the opinions expressed in this video that alone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Now, for those of you who are clients, we did do the big rebalance yesterday. Picked up, we replaced the short-term treasuries with long-term 30, 25 plus year US or zero coupon US Treasury bonds, and happy to say up 2 days in a row. That's always good. Those of you that trade your own stocks know that you think you've done all the research, the trend is right, you push buy, and then mysteriously that's when it starts going down. And so I often expect that. But it just is the nature of how the markets work. But I'm very happy to say that we're up. We had 2 nice up days in a row, and we're going to take a look at, of course, all that data today within the bond market and kind of see, what is going on, what is the big break that is about to come, and it may come in the short term, may not happen. Obviously, we don't know exactly, but the opportunity of what the bond market is going to do for not only bond investors, but how it's going to literally yank the rug out from under stock investors is really, really interesting. And people often say, well, I can tell, I can tell this time of recession is coming. Stock investors, I missed it in 2000, missed it in 07, but I've learned my lesson. I know I can see it coming, but you can't see it when stocks rise on mediocre news and are sitting near their all-time high. Meanwhile, the bond market's sitting near its all-time high, and there's one that matters more than the other. It is always the bond market. If you really want to understand how the stock market works, start studying the bond market, because when the stock market's got the most people it can get in it crammed into stocks, the bond market comes along and goes yank, and then you get a recession. Happens every time, and it's always courtesy of the Fed easing, which they are. Well, of course, we'll look at all of that again. I know many of you who watch this have read all of that stuff that I've said, but nevertheless, we'll go over some of it because it's always relevant to kind of just make sure whatever your investment thesis is correct, and something you constantly have to check on. No matter if you're a big investor or small investor or what your position is. All right, I'm trying to fix my microphone here while it is. All right, let's take a look at the M2 money supply versus recession. The gross rate increased right on the money to 6%. Now, part of the reason this is happening is that this data goes back to the end of last month. And so going into last month, the U.S. government is ending its fiscal year. And for those of you who work for governments and understand budgets, know that if you don't spend it in government world, then you get your budget trimmed going in the following year, and the federal government's no different. So there was a last minute burst of spending spree in the last month, and that is now over. So we saw the broad 12-month rate of growth on the money supply increase. We're seeing a 6-month rate of growth increase, 3-month rate of growth increase, but that should end now, and we should start seeing the U.S. Treasury, which is, as far as I can tell, behind the curve on its big borrowing binge, start to get going and pull some of this liquidity out of the economy. I don't believe they've updated the data on that yet to see. So all we know is the tax data has come into the Treasury coffers. But in terms of the size of the U.S. Treasury auctions, the big borrowing that I thought was supposed to happen last month, that a lot of experts said was supposed to start to last month, they don't see a lot of evidence of it happening. Commercial industrial lending, this is really one of the big drivers of the bond market. So you see the 12-month rate of growth is down to 6.12%, but look at the 6 and 3 months. Now, the 3-month was slightly negative. The 6-month was close to zero. They bumped up a little bit, but if you multiply this by 2, it puts you at roughly 1% of your growth, and that is nothing. And this you put multiply by 4, you're right at 1%. So it's telling you commercial industrial lending at the moment is growing at a rate of 1% a year, and that is super weak. And as these continue to stay weak and will soon roll down, obviously, the 12-month rate of change, like you see here and here, and you'll notice the 12-month rate of change crosses, mid-late into the recession, because it's already past when the 3 and 6 month have already said, hey, there's a recession here and the party's over. And we're not seeing much demand out of consumers, at least looking at credit cards and other revolving plans. They're still flat at a 3.75% annualized growth. This isn't overly high. It's not showing a strong demand from consumers at all. Now, I'm not going to go over the ISM charts we went through on, I believe, Wednesday. So if you missed that, I would encourage you to go back and watch that and take a look at the factory data. It's very, very eye-opening. So this is the AAI equity allocation relative cash. This is a survey of investors, and what it's showing is a high allocation to stocks. You can see the last 3 times where it was the highest in history, and now we're cranking back up there as investors are once again chasing stock prices higher. Look at the unemployment rate with the good time to buy large household goods survey. So consumers have less appetite for buying durable goods. This is classic late sign that we are late cycle. This is according to Deutsche Bank research. And you can see that consumers are cutting back on large household good purchases, and that should send the unemployment rate higher. And then the last chart we have here, this was provided by Meridian Macro. University of Michigan current economic conditions, which we will talk about next week, and next week's update about consumer confidence is rolling over. You see money market assets are, way down. And when money market assets are down, and you can see looking back at this chart, I don't have a line tool, but you can get the idea that money market assets are headed lower. And consumer confidence should continue to fall. Why is that? Well, it's really simple. When people look at what's in their bank account and they don't see much, well, what do you think their confidence is? It falls. And so what we're seeing is money market account values are falling, and so too should consumer confidence. And I think that's it for that. All right, well, hang on a second and let me get the next set of things loaded up. All right. So let's take a look at the NASI, the Nasdaq McClellan Summation Index. Proxy for liquidity broke back below zero, although I'm going to guess today that it went back up. I don't know why this thing is changing ads every few seconds. Kind of annoying. But anyways, it says liquidity conditions are very tight. You would not know it by the price action yesterday or today. As far as I'm concerned, why don't we just do this here where he says turn 1,000 into 1.3 million? Oh, it goes away. Maybe that's why you move your mouse over and it'll disappear. But anyways, liquidity conditions remain extremely tight, but buyers don't seem to have a problem with it. They seem to want to buy stocks right now. And despite the fact that large commercial banks are backstopping the bond market, as I've said, this is an ongoing validation of why you want to buy bonds is because the biggest players in the market are buying bonds. And here we can see this week that they increased their mortgage-backed securities by $9 billion. Were flat on their Treasury securities, dropped their, $1 billion of not, these are mortgage-backed securities that are not guaranteed by the government, and they dropped about $10 billion of their these are just regular bonds that they unloaded. But the key part is banks are buying mortgage bonds, and when banks buy mortgage bonds, that means they originate fewer mortgages and interest rates go down because demand goes down. Now, one thing that we've looked at, and I don't know if this hasn't updated or maybe I didn't move the slider over, but I noticed here this report that we saw starting early in September. Now, we don't see this here. We'll go back and look at a second that U.S. Treasury and agency securities, mortgage-backed securities at all commercial banks actually fell and interest rates went down. And everyone got excited that, oh, man, this is the top in interest rates. And then, boom, interest rates bounced and went up as banks started adding back. And I thought, well, this is strange because we can go right back over here where the data should be pulling from. And let's look at the government insured mortgages, and we see no decrease. I mean, I show a steady increase, and then looking over here, these are this slight decrease, $2 billion is not very much, but pretty much consistently across the board. So what could be happening here? This could be those Fed repo operations where banks were loaning the Fed U.S. Treasury agency or U.S. Treasury securities, Treasury bonds, and mortgage-backed securities for overnight cash. Now, that would make sense because when the Fed does buy mortgage-backed securities, interest rates go higher. But what's interesting over here, they didn't actually drop them off the balance sheet because it was a collateralized loan that had to be paid back. So maybe this starts to shoot back up as those loans gets repaid. I don't know why there's a discrepancy between the two. All I can tell you is there is one. So let's talk about the ag sector. Clear some of these tabs off. Make sure you're still with me. So we've got some colder weather coming. Remember, I said when colder weather comes into the Midwestern region, harvest is not scheduled. The bigger harvest is not scheduled to start for 11 days, and then they're going to run into November. And this is not what farmers want. And because what happens when you get frost on crops that are not mature, it just pretty much stops the growing process. So not only do they not want colder weather, they don't want rain. And guess what? They're going to get over the next 6 to 10 days, going right into big harvest time. Now, after that, they get a bit of a reprieve. They're only getting slightly colder weather and no rain, which obviously will make it a little easier when they bring their equipment out. But what I finally got a pretty interesting source on Twitter called BAMWix. Don't know exactly what their full name is, but they're at BAMWX.com, and they sell a service, but it looks like they're posting some good information on the cold front. So it says new GFS still has strong cold front next week with widespread killing freeze. Again, that means crops stop growing. Also accumulated snow. So we can look here and you can see below freezing temperatures right here in the heart of a lot of where farm crops are being grown, right in heartland there. And looking over here, you can see that freeze is still going across into other states where crops are being grown. So that's not good. So this is, again, overnight weather. It doesn't matter. As long as there's frost, crops problems. And then you see in the upper Midwest, snow. And if you want to know what really ruins crops, it's not just frost, but put snow on them before they're harvested, and you've got a problem. So I thought that was pretty interesting. And we'll start tracking their data feed now going forward. So let me clear that out of the way. And let's take a look at some of the non-farm payroll report data. One thing I like to look at, I meant to look at this earlier this week, is total construction spending against the year-over-year change in non-farm payrolls. And you can see construction spending is weak. And when construction spending gets weak, you can kind of get the idea over here. And over here, non-farm payrolls go down. Why? Because construction is a big employer of jobs. Now let's also go in here and let's get rid of construction spending. And let's change this to what the normal reporting is. So you can see non-farm payrolls as they roll down, you enter a recession. So you can see that as they roll down. And look, you can see the trend is not strong. We're at 136,000. We went from 168 down to 136. So the trend is headed lower. Now, you might get impression from the Fed or out of the White House or anyone who's publicly talking about, those are going to be the two big ones that you're going to hear about, that everything's A-okay. Well, let's take a look at when we took overlay 3-month Treasury bills, which I'm using as a proxy for the federal funds rate, against total non-farm payrolls on a year-over-year basis. So we have interest rates in blue, year-over-year change in non-farm payrolls. So you can see when interest rates start to go down, total non-farm payrolls do. So you see down, and I'll move the mouse out of the way so you can get a look. You can see the non-farm payrolls lag a drop in interest rates. And why is that? Because in a debt-based economy, lower interest rates are deflationary or disinflationary. They're disinflationary until they're deflationary. And that tightens financial conditions. And when you tighten financial conditions, employers don't hire or they start laying off and non-farm payrolls drop. Well, if we zoom in a little bit, you can see that here this is rolling over and headed lower. And guess what that's going to spell for non-farm payroll? So if we even zoom back out to the last two recessions, you can see when it starts to dip, that signals kind of the end of the show. And then as these continue to slide, the Fed gets aggressive, lowers rates. That causes short-term and long-term interest rates to go down. And boom, next thing you know, you're in the midst of a recession. So I thought that's really interesting that, the market was very excited today, as we'll look at momentarily, about this payroll report. And it really, I don't get it. I'll show you some more on that. Let me clear that stuff out of the background. And here we go. Okay, so here is the S&P 500. Looking back over the 2 years. Today, we'll zoom in before we zoom back out. See this dotted purple line? This was resistance, 50-day moving average, a big sign of resistance, and it just busted through both of them as if there was nothing standing in its way. So all the people that were short here got flushed out. All the people that were short here are starting to get flushed out. The question is, how much more momentum does this have? I don't know. I don't see it going all the way back to the top, but you have a potential double top scenario here. Now, here's something really interesting that I think is worth looking at. Let's overlay 3-month Treasury yields, which is symbol IRX on my system. And let's zoom, back away, out. Check this out. So going back to 2000, look what happened when 30-year Treasuries started to fall. It signaled, again, the peak of the market. Look here, 30-year or 3-month Treasury yields started to fall. Stocks peaked. Look at this, 3-month Treasury yields falling. What do you think this is going to do? Bull market version 2.0? You can see every time yields start to lead, stock prices fall. That's the design of our monetary system. This pulls liquidity out as people start buying bonds, and then all of a sudden it flushes stock market investors out, causes the Fed to panic. Fed goes crazy, lowering interest rates, and then yanks the rug right out from under the stock market. There it is. So anyone that's saying, oh, look, the stock market's going to go higher and higher, well, if that was the case, yields need to be going higher, and they're not. But I can't give you much more conclusive evidence, but look at how clear it is. You have the last two recessions, yields forecasted the drop in stock prices, and here you go again. That's why when I look at this chart today, I kind of go like, okay, well, yeah, it's going up, but man, the Treasury yield or Treasury yields are saying a completely different picture. And the bond market, now if you're wondering, the bond market is huge. The stock market's big, but the bond market's like woof off the screen big, way more government debt than there is market cap of the stock market. So when the bond market talks, remember that commercial when E.F. Hutton talks? When the bond market's telling you everything, it's telling you, look, this top of this market is pretty much over. But yet people wanted to chase a low volume non-farm payroll report higher because they must think that this is the bottom. But again, based on the fact that the manufacturing sector is contracting, employment is contracting, and the services sector is marginally expanding employment, it doesn't make sense why people are driving this price up. Now, one aspect is you could look at volume and say, well, these aren't very high volume moves. You could simply say perhaps the big players are letting the small players drive prices back up before they sell because they're not done selling. That could be. Let's take a look at volatility, something you would never buy nor sell or do anything with. But here is the VIX volatility index. You can see it ran into support right along here and found people who are sellers. Now, before you think, oh, well, then volatility's headed lower, prices are going to all-time highs. When volatility starts bouncing off its 200-day moving average, it signals a bigger move is coming. So it'll be interesting if this gets down next week, tags its 200-day moving average and holds, or its 100-day here in blue. The 200-day is in tan. But whatever it is, people still think that you want to be short volatility on a low quality employment report. It's a bold strategy, and we can look here at, again, the VIX ETF, again, that you will not buy or sell, and you can see it's coming down and potentially going to retag support here and perhaps bounce off of that. You can see it hit resistance and rejected. The question is, will support hold? A lot of buyers right here, so it looks very, very likely. But what is well, I'm going to get to the chart in a minute, but if you're really bullish about equities, you have to look at small caps, which do lead the big boys lower, because when small companies start getting in trouble, well, guess what happens with big companies? This is a monster topping pattern. And I've got these two lines here showing this is what's called a supply zone where buyers have been. And you can see every time it gets down in here, buyers have come in and bid prices higher, with the exception of this big drop here. It's been very consistent right in this zone. So when it got down in here this week, what happened? Buyers came in. And what you're looking for in terms of this falling apart is what kind of thrust do the buyers have? How much ammunition do they have to drive prices higher? And when you come out of the supply zone, and you'll notice they're not really making new highs. I mean, obviously, here's the high. Here's the all-time high. So when you see weaker and weaker bounces, what it's telling you is all the people who are desperate to buy small cap stocks are running out of money. And when they eventually run out of money, then this supply zone of buyers turns into the support turns into resistance as price breaks down. So when this breaks down, then it's going to come down to this level. The question then would be, is after almost 2 years of buying, so we're going back to September 17, so 2 years of buying, is there going to be anybody left when it gets down to here? Well, there might be. And if there are, then you can zoom out a little bit more. Oops, we'll zoom across this way, because then you're looking at a bigger drop somewhere down into here. So this is a big topping pattern, and the way you know that is not setting new all-time highs. In a bull market, you should be seeing consistent rising prices like this. This is a topping pattern. But what is the chart to watch? The one that tells you all the bad things that are going to come, and it's the 10-year Treasury. So I'm going back 2 years now, and we can even look at the prior expansion following 2000, looking back at 2003, and you can see coming across here, if I were to draw a line, and maybe I can move one up here, duplicate. Oops. There. Man, this is being finicky. Here we go. And you can see that at some point, 10-year Treasury yields were breaking down and then just fell off of a cliff, okay? It's not as clear of a topping pattern. You can see the topping pattern here, but it had a couple dips below before it blew down. Let's zoom in to the chart. The one thing that only thing that should matter to the markets right now is this chart right here. And what you see is 10-year Treasury yields bottom roughly around 1.4%. And then they found sellers. So this is inverse bonds. So people sold bonds, drove yields higher. Then buyers came in, brought yields down. This is the smart money that's buying the yields, bought yields down, brought yields down, because they've been buying bonds, as we know, and then got shorted higher, and then smart money buying bonds. This is a topping pattern in bonds. And when it breaks, and it's pretty unusual, they have 1, 2, 3 at the same spot. And people are saying, oh, this is going to bounce off here and just go straight up. Yeah, that's pretty unlikely when commercial industrial lending is growing at a 1% rate per year. And you have large commercial banks buying mortgage-backed securities, okay, and Treasury securities. But how do you read this from a technical standpoint? Because this is a technical pattern. When this does eventually break down below 1.4%, it's going to pull the whole market with it. And how far are yields going to fall? Well, it's pretty simple. You take the lower bound and subtract it off the upper. Now, I'm not going to go right here to the top. Let's just kind of use somewhere in the middle here, right at 3%. So you take 3% and subtract 1.4, which you get 1.6. And then you take the 1.4, subtract off 1.6, and it tells you the big players think 10-year treasuries are going negative 0.2, and may actually go lower. The reason that may be is because you have hedge funds that are short bonds, you have speculators that are short bonds, you have institutional money managers that are short bonds, and you have retail investors that are short bonds. So you say, wait a minute, retail investors are short? Well, they can be short by just not owning them. So if you look at their portfolio composition, virtually nobody really wants to own U.S. Treasuries because they think inflation is going. But they're sitting near their all-time historic low right now. And they don't own them. So what's going to happen? I mean, really think about this. What they say today, the unemployment rate hit the 50-year low. What's going to happen to interest rates when that goes up? If you're at a 50-year low in unemployment rate, where do you think interest rates go when unemployment rises? Are they going to go up? No, because our monetary system doesn't work that way. When people lose their jobs, they stop spending. When people stop spending, interest rates go down. So you have the largest topping pattern in 10-year treasuries in history. Let that sink in a minute. In history. The opportunity in this market isn't in stocks at their all-time high. It's in bonds when they force everybody to buy them. This is the rug pull. When yields break below 1.4 and start catching some steam, all these people are going to turn around that don't own them are going to want to chase this bull market because they're going to have to chase it because one, they're short and now they're going to get squeezed and yanked out of it. But it's going to pull liquidity out. It's going to just grab liquidity and yank it from the market. It's going to vaporize. And stock prices are going to go down and volatility is going to go up. And people are going to start buying treasuries to hedge their losses. If you want to know what causes bear markets, it's not just stocks falling. It's triggered by interest rates breaking out into a new bull market. And in this chart right here, a new bull market in interest rates begins when you break through this topping pattern that's gone on for 7 years. A 7-year topping pattern. So all the smart money that's buying bonds, that ever says, oh, never buy bonds, interest rates are going, we're going to have hyperinflation and real high inflation. Look, all this smart money that's been buying bonds wants to get paid. And they know when they yank this floor out from the market, boom, they're getting paid. Is this the move that breaks it? Could be. Everyone thinks this is, notice the difference here? This thing went down and it steadily went up. This went down, popped up, and boom, it's coming back down. Came down, popped up, came down, and then went up. This next touch of 1.4 is going to be real interesting because the broad economy, you want to talk about inflation? How are you going to get inflation at 136,000 payrolls per month? Not going to happen. I mean, if interest rate, again, let's think about this. We're 11 years into an expansion. We're creating 136,000 jobs last month, if that is the real correct number, which we'll see in the months that come. And interest rates are sitting near their all-time low. I'll get off my soapbox on this, but I just want to and let's add to that. You have oil and gas producing stocks that are sitting near their all-time low. How is that inflationary? It's not. Let's look at crude oil. It's at 53 a barrel. Do you know what the Permian break-even is? 54. Do you think the oil companies are going to be hiring? No. They're going to be laying off if oil prices don't rebound. If oil prices get down to 50 and don't find buyers, it's going down to 42. You want to know where there's a lot of debt? Small oil producing companies in the Permian are massively overloaded in debt, and based on this price, they're losing money. That's why you want to own bonds. And look, here's TLT, 30-year, 20-plus year Treasury, essentially 30-year bonds, right near its all-time high. Here, let's look at 7 to 10 years. Here's how we had on yields at the triple top or triple bottom. Here's 1, 2, here's your triple top, but just not in the same. This breaks out and boom, it just sucks all the wind out of the market. The big play is in bonds. It's not stocks. Let's look at ag commodities real quick. I see it consolidating here. This is really good. It's holding support. We know the freeze is coming, and the market is completely unprepared for this. So this is excellent. You've got a relatively strong dollar. And wait till third quarter earnings hit. You're going to hear complaints about the dollar and the trade war, which, mind you, on the somewhere, I think, 10th next week, we get the EU tariffs. And then the week after that, we get the China tariffs. Now, there's going to probably be a meeting with China in here. And of course, all you're going to hear about up until that meeting and through the meeting is how there's going to be a deal. And there probably isn't, but you're still going to hear about it. Let's take a look at gold mining stocks. They're trying to break through, or they did break through support, which turned into a resistance. They broke through resistance. Again, can they make a new all-time high, or is this the last gasp of the bullish people on gold before gold follows suit? Look, folks, this isn't pretty. The economy is very, very late cycle, and everyone's piled into stocks. You've seen it when yields are the answer. When yields go down, sucks the wind out of the market. You'll see a big collapse in treasury yields, a huge surge in bond prices. Again, I'll just show you. I'll hear it. Let's go look at TLD, 20-year weekly chart. Where is 2008? Right here. You want to own bonds? There's your 30% return. And how did it happen? In about a month. Why? Because here, 1 top, 2 top, 3, 4, 5, 6, boom. Eventually, smart money gets paid. That's why we bought a lot of bonds. That's the payday. Unless you believe that 136,000 payrolls is the bottom, it's not. Watch the data coming up. It's going to get worse. The global economy is telling you everything you know. I'm Steven Van Metre. I'll see you Monday. We'll take a look and see how the hedge funds, see if they're shorter bonds. Remember, interest rates don't bottom until the hedge funds are long. See what they're up to next week. Have a great weekend. Bye now.